In 2020, the stock market was able to survive two major events, the pandemic and the uncertainty around the US election. But the question we now face as investors is, will this resilience continue in 2021? And are we going to see similar returns over the next few years like what we've seen over the last decade? Or will the share market drop from its record levels and things instead take a lot longer to recover and we have to wait longer to see a significant return on our investments? Now, I've got almost 200 grand invested into the stock market at the moment, and I've also got some additional cash on the side to buy more shares in case it drops further. So let's get into today's video. The stock market in both the US and Australia has seen such a dramatic rise over the last 10 years, primarily fueled by low interest rates. When interest rates are low, this means that the return people get from putting their money into a savings account just isn't worth it. Currently, interest rates are only at 1 to 2%, meaning that you'd only get paid $8 a month if you had $10,000 in a savings account. Now, given that this is lower than inflation, people have been seeking out other investments like the stock market. And this increase in buying activity has played a huge factor in driving up prices in the share market over the last 10 years. It's also caused companies to borrow more and more money due to the ease of available credit and loans in order to drive their business growth and deliver returns to demanding shareholders. People also borrowed more and more money to fund property purchases as well. All of this was driven by the idea that this debt could easily be repaid because of low interest rates. But then in February last year, people realized that the pandemic was going to result in long-lasting lockdowns, causing the share market to crash on fears that all this debt could not be repaid. So for example, someone who had taken out a business loan to fund a restaurant wouldn't be able to repay the bank back for that loan due to that restaurant not getting any customer foot traffic, and the bank would be left with unserviceable debt. This caused panic selling in the stock market because people were worried that this was going to cause the next financial crisis. But then the US Federal Reserve stepped in and bought $500 billion in treasury securities and $200 billion in government mortgage-backed securities. It also provided loans to businesses in order to ensure smooth market functioning and the ongoing supply of credit. Governments also released trillions of dollars worth of stimulus packages as well. These factors, combined with bets on the vaccine rollout, resulted in the share market roaring back to life and hitting new record highs. So what's the issue now then? Well, the problem with all of this money printing is that it's disrupted the smooth creation and supply of money, especially in the United States, where 35% of all US dollars in existence have been created in the last 12 months. What this means is that as more and more US dollars are printed, the value of an individual dollar starts to go down. There are many other reasons for this though, and one of it being that there's at the moment a fundamental mismatch between demand and supply. Consumer demand is now starting to go back up. People have saved up a lot of money during lockdown and they're now keen to go out and spend it. But the supply side just hasn't been able to keep up due to high commodity prices, supply chain issues, and trade security. One example of this is the new car market, which at the moment is struggling to build new cars because of a supply chip shortage. And as a result, people are now turning to the used car market, which is likely to explain why prices have increased for used cars. Now, this is an issue because as the price of goods and services continues to increase in value, this may actually get out of control, and then people can no longer afford to buy things. So to combat inflation, central banks will eventually have to raise interest rates in order to slow down the rate of demand growth. But the problem with raising interest rates is that investors no longer need to buy riskier assets in order to get high returns, because they can instead move their money into safer investments and get similar returns, like term deposits. As a result, recent inflation data has caused a sell-off in the share market, especially in the tech sector, which is extremely overvalued at the moment. So the reason why we've seen a sell-off in the tech sector due to rising interest rates is because at the moment, the tech sector is really overvalued. And this is because their share price has been pumped up by future expected cash flow earnings. But with increased interest rates, these companies are now going to have to start paying more and more money on their loans. earnings, reducing their bottom line cash flows or the value of their future cash flows. To put simply, investors are worried that these big tech companies won't be returning as much in the future than what is currently expected. Looking at the inflation numbers in a bit more detail, you can see that this number has a lot of people worried. This 4.2% increase in inflation, which is the biggest year-on-year increase since September 2008. Now, the way that inflation is being measured in this report is basically just looking at the price of things that consumers buy, like food, energy, and other services. And you can see for things like gasoline and fuel, there has been a huge year-on-year increase as consumers come out of lockdown and spend more money on fuel. The more and more we get these surprising increased inflation figures, then that increases the chance of the US Federal Reserve raising interest rates a lot sooner than expected. At the moment, technology stocks have a much higher price to earnings ratio than their 5 and 10-year average. So it's likely that when interest rates do rise, tech stocks will fall back to reasonable valuations. So the key question that we need to ask ourselves here is, are these inflation figures just transient, or are they going to continue to rise for a much longer period of time? And the reason why this is important is because the chair of the US Federal Reserve, Jerome Powell, has made it clear that they are unlikely going to raise interest rates until 2022, and that the only reason that they would do it sooner is if inflation remains above 2% for a considerable period of time. So how do you know whether this is going to happen? Well, again, you need to think about whether supply is going to improve across this time, and also whether demand is going to continue to remain high. It could be possible that when people do come out of lockdown, they are going to continue to spend money, but that only lasts for a short period of time. Or alternatively, this spending demand just continues to remain in place, pushing up the price of goods and services, and the Fed having to step in and raise interest rates. It was recently argued by Greg Jensen, who's the co-CIO of Bridgewater Associates, that household savings are excessively high, and there's also a pent-up demand to spend that money as well. He said that by the end of the year, those household saving rates are likely going to go down as people go out and spend more and more money, putting an upwards pressure on inflation. But if you look at the comments made by Jerome Powell and other members of the US Federal Reserve, it's clear that they're of the view that these inflation figures are only temporary. Looking at the data in more detail, the increased prices were for cars, airfares, lodging, and food away from home. And these goods and services are transient in nature. Regardless of these issues, it's really important to have an investment strategy that takes into account this economic scenario. Now, again, I want to stress that the following part of this video is in no way financial advice and has just been made for entertainment purposes only. Please do your own research. If I had a lot of money saved up at the moment, I certainly wouldn't be putting it all into the share market at this point in time. And you can see that the Nasdaq has risen by almost 100% over the last 12 months. But you can also see that over the last 3 to 4 months, it's basically just topped out. And I think it's going to remain there for a while before we see any further increases. And that's only going to happen when nerves have been calmed about rising inflation and interest rates. If the Nasdaq though does go down in value, I'm certainly going to buy more. At the moment, it has fallen down a bit, but I'm going to wait for it to fall further. And if it does, then I'm going to buy more ETFs. The other thing to consider is that even if interest rates do go back up, they're certainly not going to go back up to a point where it's better to put your money into a long-term savings account compared to the share market. Interest rates would need to go up to 4 or 5% in order for that to happen. So in my opinion, I definitely think it's worth continuing to invest in the share market over the next 5 to 10 years, as opposed to putting your money into safer investments. That being said, if interest rates do start to go back up, this will make value stocks more and more attractive. This is because value stocks are not overpriced compared to tech stocks. With rising interest rates, this makes tech stocks more and more risky to invest in because of the possibility of their discounted future cash flows. Therefore, investors are likely going to return to value stocks, which are more stable. And by value stocks, I mean things like blue chip companies. So one investment that I'm therefore looking into at the moment is the Vanguard Global Value Equity Fund, which only has a management fee of 0.35%. Now, this fund invests in securities that are fundamentally lower in value than other stocks, as measured by things like their price to earnings ratio and price to operations cash flow. Now, these securities aren't just from Australia, they're also from other international developed markets. Now, this is a managed fund, and if you instead want to buy the ETF version, you can go and check out the Vanguard Global Value Equity ETF, ticker symbol VVLU, which just does the same thing. Now, I'm certainly planning to do this as I save more and more cash. One thing I'm not planning to do though is invest all of my money at once, nor sell any of my shares, because I know in the long run, things will eventually go back up. It's always important to remember that patience is the key when it comes to investing. And despite all the clickbait videos on YouTube and the warnings by Ray Dalio, I don't think that the share market is going to crash if interest rates rise. I personally just think that there'll be a fall of about 10%, and then after a while, things will eventually go back up and rebounding to new highs. And the reason why I think that this is only going to be a temporary correction is because Amazon, Facebook, Apple and Google all smashed expectations in their recent quarterly earnings reports. Amazon reported its first quarter revenue to be over $108 billion, which exceeded the $104 billion expectation from analysts. Facebook reported a net income of $9.5 billion. Google reported revenue of $55 billion, up from $44 billion a year ago. And Apple has said that revenue from its iPhone has soared by 65% in the last quarter to $48 billion. In my opinion, these companies are only just continuing to grow and innovate. Any setback, in my opinion, is only going to be minor. And that's why I'm planning to buy more NASDAQ ETFs when the share price falls. Unfortunately though, this does mean at the moment that my NASDAQ ETF is down around 4% or $5,000. My Robo ETF is also doing really bad as well. It's down 14% or almost 2.5 grand. But luckily though, I've only got about 10% of my overall portfolio on Robo. So it's not having a major impact on my overall portfolio. That being said, the road ahead is going to be a very challenging and bumpy ride. It just means though that I'm not going to be putting all of my savings into the share market at once. And instead, I'm just most likely going to dollar cost average. I should also point out that this likely means that the Australian share market going to go up in value if there is inflation in the US market. And this is likely due to the fact that if the price of iron ore continues to go up and rising interest rates mean more profits for the big four banks, it's going to mean that any losses on my NASDAQ ETF are going to be offset by the rising cost of my ASX 200 IOZ ETF. So despite all of these nerves in the market at the moment, I'm really not that worried. It's really important to not let daily headlines influence whether you want to invest in the share market, because then you're probably just going to make the same mistake as I did, which was not simply investing earlier. I'm a big fan of the old saying that time in the market is always going to be timing the market. So thank you so much for watching today's video. Be sure to like, comment, and subscribe to the channel. Thanks.